combat volatility.
Welcome to Barry's Bites. Please join our host, attorney and financial advisor Chris Barry.
I wanted to share just some of the tools that we're using with clients right now to combat volatility and talk about how these work. So I-bonds have been a great tool over the last year or so where they're based on inflation. There's certain limitations, but previously they were at over about 9% for 6 months and then dropped to 7% and probably are going to drop further as inflation, at least from the government's perspective, has slowed down a little bit. And there's some limitations, only $10,000 per person. So it's not something that's really going to move the needle a lot, but it was a great tool. And I'm not sure if it's going to be a great tool moving forward. I think historically, I-bonds have really only offered like a 1-2% rate of return historically. So just given the insane inflation we had recently, that's really what made the I-bonds a good bet. Another option is T-bills, Treasury Bills. So with interest rates where they're at right now, especially short-term Treasury bills are getting 4 or 5%. So better than leaving the money sitting in cash. Then we have high interest savings accounts. So these are liquid. You can find some online. We have one right now. It's an online account, savings account, completely liquid at 4.4%. It's FDIC insured. It's protected, especially with all the bank questions. That's been a big concern, is making sure everything's FDIC protected. And so you can look at high yield savings accounts, which is a liquid option. And right now we have one offering 4.4%. It's not guaranteed. It could drop, but you could always move the money somewhere else. Something more longer term, we have kind of more market-based, is we have defined outcome ETFs or buffer ETFs. This is money that's liquid. It's in the market. And what happens is there's a buffer on the downside. So that buffer might be, let's say, 20%. So if the market drops 10%, you wouldn't lose anything. If the market drops 25%, you would lose 5%. So that's how the buffer works. Of course, there's a trade-off, and the trade-off is there's a cap. Let's say the cap is 12%. S&P 500 goes to 15, you would get 12. If it goes to 10, you would get 10. So especially with kind of how sideways people think everything will remain over the next year or so, we've had a lot of clients interested in these defined outcome or buffered ETFs. Similarly, structured notes are less liquid than, say, defined outcome ETFs, but there's some different things that we can do there to build in principal protection, where depending on how the markets do, it could act similar to a buffered ETF, or it could build a baseline, a little more complicated. And then next we have Index Universal Life Insurance, or IULs. We have some short-term ones that for a year where you can get a fixed interest rate of 3 to 4%, and then you can pull the money out. Could be tied to the markets, where if the markets go up, you could collect some upside. Or we have Index Universal Life on a longer chassis, like a 10-year chassis, where it's principal protected. You put in money each year and it grows tax-free. And then the other thing, most people are somewhat familiar with these, we have fixed index annuities. You're trading liquidity for principal protection with the opportunity of growth. Some of these you could get anywhere from a 0 to 20% rate of return in any given year. Generally, the growth ones average about 6%. So those are just some of the tools that we're using to combat volatility right now. I-bonds probably will be coming off this list as we get interest rates under control. You have to lock up the money for about a year at minimum with the I-bond. Treasury bills, you're looking at typically 6 months to a year. If it's money you're not going to touch, you might get a 4 or 5% rate of return. High interest savings accounts, these are completely liquid. You can pull the money out at any time. Right now, you're getting about a 4.4% rate return, at least on the ones that we have. Defined outcome ETFs and structured notes, these are kind of putting the money into the market, but building in some principal protection. Typically, you want to leave the money in for at least a year or so. IULs, we have longer duration IULs, typically on a 10-year chassis, as well as kind of short-term IULs on a couple-year chassis. Again, you're building in principal protection. You're using insurance companies versus the market on these. And then fixed index annuities, again, you're using an insurance company instead of a custodian like TD Ameritrade or Altruist or Schwab or Fidelity for those things. So it's really figuring out kind of what the goal is and then figuring out what's the best tool if we do want to combat volatility.